Hello, good afternoon. Well, it's afternoon for me. Good morning, or the time you're watching this. All right, so I'm back. That's it. All my traveling done now till October. Did a lot of flying, so time for me to sort of catch back up with you guys. I want to try and start doing this again a bit more consistently. I don't know if you guys like it or not. Not really had much feedback, so if you can give me some, it's really, really appreciated. Um, so I hope you guys who are based in the Middle East enjoyed your Eid break this week. Maybe you're currently away, but just really wanted to reach out, discuss, I guess, what's happening in the world. I want to discuss the current state of global financial markets. Why now is the right time to be investing, some things to look out for as well. And certainly, if whether you're my client already or whether you're a new client or a new potentially new investor, okay, this information is crucial. Okay, and as always, really, really recommends that you take some form of advice so that you're not putting yourself at risk or unnecessary risk. Okay, so let's just dive into this a little bit. And really, what I want to start with is market sentiment right now. If you see me keep looking over this way, I've got a list of things that I want to make sure that I cover off. So let's talk about market sentiment. Okay, so at the minute it's dominated by the anticipation that core inflation is going to come to an end at some point. Central banks, okay, around the world, including the recent rate hikes in Europe, they're sort of reiterating the message that core inflation is going to remain stubbornly high. Okay, and this poses potential risks, particularly in the UK and Eurozone. And the reason for that is it may delay, okay, the next economic cycle, okay, and increase the chances of recession. Okay, recession, it's a bit of a fear word, but it's not something that we've not discussed in the last 18 months, if you like. You know, I'm sure most people are aware of what's happening in places like the UK and the Eurozone. And the only difference is that that's really just going to get slightly worse. Okay, if you want a bit more detail on that, speak to me. Happy to go into the really finer points on that. But the silver lining is that the markets have already priced this in. Okay, the expectation of higher for longer interest rates. People, this has already been priced in. You will have heard me speaking to you about it, may have read it on market updates, but we may need to get used to this new norm, okay, where we have high inflation, again, we've got the high interest rates as well. Okay, and below, before we've always, the government or central bank targets has always been 2%. Okay, well, maybe we actually need to enter this new period where that's more likely 4%. Let's see. But what that has led to is an adjustment in corporate earnings for the following quarters. And as a result, European and Japanese stocks are actually looking like they're offering fair value compared to the US market. In the bond market as well, if you look at the Anglo-sphere government and investment grade corporate bonds, okay, they're actually looking quite attractive compared to normal deposit rates and stock market dividend yields. So again, you will have seen on my market update, there's a number of fixed deposits out there at the moment offering some quite attractive rates. There is actually some other opportunities. Again, speak to me to find out a little bit more detail, what you could sort of avail. Right now, fixed deposit for sterling is over 6%. So certainly something worth discussing. I'm not sure what your bank is offering you. Wanted to sort of also touch upon the Russia and Wagner Group situation. Okay, so market-wise, markets have remained relatively unaffected. However, it does introduce geopolitical risk that does need to be considered. Now, Putin hasn't been overthrown. Okay, he's not really loosened his grip, but if you're thinking long term, certainly. If someone does come in and replace Putin, it would not be sensible to just automatically assume that he's going to be in the frame of mind where he's happy to come and do business with the West, that we're going to immediately repair relationships. No. So something to consider, and actually it could disrupt more commodity and even food and energy supply. So we could potentially be looking at increased prices. You will have seen, hopefully today, Saudis and Russia are looking to cut back oil again, just to keep the price high. Something to be mindful that if it's not Putin and it's someone else, that could potentially get a lot worse. Okay. Just want to focus, mentioned it a couple of times, just want to focus on to core inflation. Okay, while headline inflation is declining in most countries, okay, core inflation, which excludes food and energy, just remains stubbornly high. Okay, the driving force behind this is wage growth, okay, wage inflation, and that's been exacerbated by labor shortages. Okay, so essentially, if you're a company and you want someone to come in and do a job and you're really struggling to find someone, that person that you're looking for is potentially negotiating higher salary packets from other companies, and you may lose out. So you're going to have to be more competitive, and that's what's causing the wage inflation to come in and creep into the market a little bit more. Okay, central banks are still determined to tackle this issue, and they are tightening credit conditions. Okay, and they're trying to engineer a rising unemployment. Okay, and we can hopefully at that point expect a reduction for inflation, but yet we're still to see that come into the markets. Right. Just a couple of other points. Okay. Again, I'm just looking at the cheat sheet here in the corner. We need interest rates to start coming down at some point, and so that the new economic cycle can begin. Again, not really sure how that's going to happen at any time soon. Corporate earnings is going to really be the driving force behind that. And last thing I want to talk about is the traditional 60-40 portfolio. Okay, 60% allocated to equities, 40% allocated to bonds. Okay, it's been, that's been a really strong mentality for most investors for a number of years. However, more recently it's been questioned because, the increased bond volatility, okay, and the positive correlation with stocks. Okay, so what we've seen is bond yields have actually come down. They've certainly bounced around a lot, and the equities has come up. We may see that rebalance as interest rates stabilize and inflation starts falling. However, again, we're still waiting for that to happen. And that's really it, I guess. Certainly what we need to do is discuss in a bit more detail your portfolio, if that's something, certainly if you've got 60-40 allocation, something, there are some other areas that are quite attractive right now that can be taken advantage of. And yeah, I'm going to try and keep you informed as much as possible on market movements. Okay, sending out market updates. I'm touching on as many different things as possible when I'm sending those out. Okay, I believe it's important that you guys know what's happening. Okay, and again, as I said at the beginning, always take professional advice. Okay, whether that's from me, okay, whether that's from someone else. Okay, don't hesitate to ask the question, because it's better that you're informed and you have all the information than making a wrong decision or exposing yourself to unnecessary risk. Okay, that's all from me. Nice and quick. I think it's quick anyway. We'll check the timing, but I look forward to speaking to you soon. And yeah, have a good day, depending on when you're watching this. Thank you.